and welcome to another episode of Stock Talk Product Review. I am your host, Mike, and the gang's out for tonight, so I will be here solo, and we're just going to cover a little more about Inflation Nation, because that's what we're talking about today. We've got a little bit up here from Steve Cortes. He says there's nowhere to hide from the economic carnage unleashed by Joe Biden. Normally safe, but usually boring, Treasury bonds have been crushed because of the inflation crisis. The combination of the Biden recession and his inflation explosion equals calamity from Main Street to Wall Street. As you can see, going to the before and after of Biden taking office, and you could see where the bond market's headed since Biden took office. It's lower than it was before. That's why you're seeing all these different changes and everything as well. Writes that Biden equals big problems for small business. From the NFIB survey of small firms, Main Street enterprises have seen their profits plunge as consequence of Biden's recession and inflation. Small business profits sink to spring 2020 lockdown lows. A lot of that, too, is that you're seeing, guys, out there, is that you're seeing that businesses have taken on a tremendous amount of debt. And the problem is, with that, that's going to cut down their earnings as well. Not only with the rents up, you also have operating costs, things like that, shortages. It's all taking a toll, and they're just masquerading to what is possibly coming to the big problem here, which is the debt that is coming there, which is the big problem of the debt that is that they've taken on. So it looks like actually in the last 3 months, since January 1986 to August 22nd, seasonally adjusted, there you go. You could see we're in the 80s/70s. Let's not get to the 30s and 40s. Let's see here. CNBC is recognizing that there is a problem, obviously. Sky-high inflation alongside worsening the recession. You could see this is happening because they do not want to. Some people actually there do not want to go down with the ship as it's sinking automatically. They can keep on saying that things are good, but when things turn south there, there's going to be a lot of big problems. CNBC writes, and they have the video, you can go up and watch it. Inflation isn't just about fuel costs anymore as prices increase and broaden across the economy. This one was published Tuesday, September 13th in 2022. So there you have it. And then you have the memes going across with everybody. Biden's roll of history. And then you have it with the toilet paper. Isn't that funny? Going on to Zero Hedge. Ray Dalio, it has an article here. It says it starts with inflation. It starts with inflation. How? Interest rates, market, and economic growth relate to each and others what means ahead. In this post, he briefly explains how the economic machinery determines inflation and interest rates. And that's one thing that, guys, that you're going to see coming up here. You're going to see possibly next week, as we told you in last show, that you're going to see this the interest rates raised to about 3/4 of a base point. With that, most likely October, November, and so forth and so forth. What this is systematically going to do is crush the hopes and dreams of normal everyday Americans, and it's also going to put a pressure hold, which is what the regime is not discussing with people, and is going to cause next year going to see, coming down through October, November, December, January, a crushing of the market, in specific the real estate market there. In certain areas should be just depends on the area of that. Over the long term, living standards rise because people are inventing ways to get more value out of a day's work. We call this productivity. The ups and downs and the uptrends are mostly due to money and the credit cycles that have driven interest rates, other markets, economic growth, and inflation. All these things equal when money and credit growth are strong, demand for economic growth are strong. Unemployment declines, and all produces higher inflation, which opposite is true. More of the opposite happens. That's why I asked on the Twitter feed last night, and you could follow me on Twitter at Stock Talk. Are you better off than you were 4 years ago? Some people said yes, but emotionally no. So you're getting mixed reactions. This is a trick question, which I will answer in 7 days after people take the poll. Are you better off? Question is, you might think you're better off, but like I said in the show before, and as explained again, you are spending more and more for your daily goods. So yes, you could be making more money, and you could be having a raise, and you could have got paid out more, but you are spending more, and you're spending more in everyday expenses, and it's costing you a lot to to live right now. Most everyone sees the most important central bankers determine the amount of money and credit available for reserve currency countries. The higher the interest rate, the economic growth, the lowest the unemployment rate possible, as long as it sees to produce undesirable inflation. What's the rate of inflation undesirable? It's the rate that creates undesirable effects in productivity. Most people agree, the central banks agree, that 2% for reasons they will now digress into. So most people most central banks want strong growth and low unemployment on the other hand, while inflation rate on the other hand. So you have the two balancing acts there. In other words, inflation is high, above 2%. The tightening the monetary policy, the weakening the economy to bring it down. The highest interest rate above target, they may tighten. With the interest rate above what the central banks want, yesterday's CPI showed monthly change for the CPI 0.6, which equates to an annual rate of 7.4%, and the unemployment rate is at 3.7%. It's obviously the inflation is a targeted problem. So what's the obvious? That the central bank should tighten their monetary policy. But no, because what's happening is they have pressure from the politicians, and they're just going to keep on spending and spending and spending. They're addicted to spending, which makes to bring up to the point that people are asking, is this purposeful? Is this a Cloward and Piven strategy? That's something for you guys to answer. Is this the Cloward and Piven strategy? And are they trying to bring down the system? That's the question of the day that you can leave in the comments section. Everything that will flow to that it tells me what inflation rate will be down the road, and without the central banks pushing interest rates and money credit growth around, I can pretty much tell you what will happen. So the process starts with inflation, then it goes down to interest rates, then it goes down to the market, and then to the economy. It starts with inflation. Since the price of anything equal to the amount of spent divided by the quantity sold, the change in prices and inflation change the amount of money and credit spent in goods and services divided in change for the quantity of goods and services sold. The primary determined amount money. Let me go and switch this here so you guys can actually follow along and see this, because I'm still on Cortes's feed. My apologies here. Let me just go back here. Okay, so the primary determined amount of money credit level for the interest rates that the central banks make available, it can only be influenced by supplies, goods, and services available through supply disruptions, which you're also going to see now because you have the typhoon. One of the largest ports in China right now, there's a huge typhoon, and they've completely closed. The last ships have left. So you're going to see some of that effect come here and ripple effect in there, just in time for Christmas, huh? Central banks determine the amount of money that credit is available to spend. That is by setting interest rates, by selling debt assets with money they print, quantitative easing and quantitative tightening. Interest rates relate to inflation rates, and real interest rates have a big effect. How's that go? Then it goes to the markets. Interest rates rising to relative inflation causes pricing of equities, equity-like markets, and the most income-producing assets do show because of negative effects have on incomes. For the need, assets go down and provide competitive returns and the present value, the fact that the less money and credit available by those investment assets. The central banks need to create low interest rates and inflation rates so they make plenty of credit available. So you have seen that. People have been addicted to the cheap credit. We've seen it issue out keep cheap credit all the time. Problem is now is that the chickens are coming home to roost, and so with that cheap credit out there, that's going to be going away, and the collections coming back there. And so what central banks doing is trying to create low interest rates for relative inflation rates to make plenty of credit available. They encourage borrowing and spending and selling debt assets and bonds by investors by buying inflation hedge assets, which accelerates economic growth and raises inflation, especially with little ability for the quality of goods and services to be increased. And with that, you also have with this credit addiction, the cheap credit addiction, is now it's going to be interesting to see how everybody reacts, since they're going to be, it's going to be starting that tightening thing, that tightening that you're going to see from the higher rates for people that have been so used to this cheap credit and have had this good period of time that now you're seeing that tightening happening. And of course, the reverse is true, where they make higher interest rates and relative to inflation, which makes the supply of money and credit tight. They have the reverse effect. The tightening things settle to the levels of most tolerable. On all things considered, one of the most intolerable to high inflation is too weak economic growth targeted by central banks be changed, and policies will be changed, and the change can bring about. So the process of figuring out what could happen is likely solving the simultaneous equation of optimizing those that matter most. Applying now is what's happened. You've seen with inflation and interest rates and markets, the economy is plugging in estimates and determining what we can estimate the outcomes. As it states, the inflation rate, pick up the numbers based on what you could see ahead, is that discounting inflation over the next 10 years, 2.6% in the U.S. His guesstimate is around 4.5% to 5% long-term, barring shocks, worsening economic. So if droughts, floods, things like that. You guys, like some economists said, like Cortes and things like that, you're about 1 or 2 bad things away from happening before you could hit the Great Depression. That's how bad it's getting. The recession's getting worse, regardless of what the media tells you and the pom-poms and everything like that. Just shooting you straight, and as well as that's what some of these articles. So this is why you need to get the information out. We could talk about good stocks and things like that, but right now is the time to get things in order, because we need to get this information out there. And then we're also going to have some fun and do some product reviews too. Next guesstimate is interest rates relative to inflation. Right now, the markets are discounting 1% for the next 10 years. The relative low yield compared to what's happening long-term and the modest high rate given in recent past. What's your guesstimate? The guesstimate is based on debt, assets, liability, outstanding, and the debt service would be debtors, and real returns would mean for creditors is that real interest rates between 0 and 1% would be relatively high, but tolerable for debtors, relatively low to consider for creditors. Put inflation estimate for the real estimate together, and you have projected bond yield. If you want to estimate the short rate, decide what you think the curve would look like, and that's your guesstimate. For example, the U.S. government is going to have to sell a lot of debt to fund the deficit for 4 to 5 GDP this year, and the Federal Reserve is going to have to sell, let it roll out to negative 4% GDP. So what's the question, and what's the demand for the supply? The supply and demand, what do you think? That is the question, and you can go on and read more there to tell. He basically goes into summary and says, next you can estimate the fall of the markets and what it means for the economy and the wealth effect. When too many people lose money, they become cautious, and lenders become more cautious in lending to them. So it means they spend less. The guesstimate is the economic contraction would be required, and it takes a while to happen because cash levels and wealth levels are relatively high still. So they still have to be used to support for spending to be drawn down. When we see this happens, for example, significant weakening in interest rates and debt-dependent sectors like housing are seeing a strong consumption and spending and employment. It's going to be an interesting next 3 or 4 months, people. Get your seatbelts on, sit back for the ride. Hopefully we'll be back tomorrow. If you want to read more about this article, you can go to Zero Hedge and go to Ray DeLeo and check him out on LinkedIn. Don't make it a dog show. See you back here. It's a little bit on inflation. Appreciate you taking the time to watch the video, like and sub. Don't make it a dog show, and good night now.